Kia ora. I am Katie Wesney and I help transform people's relationship around money from limitation to limitless potential, creating wealth that works harder than they do. This webinar is not about penny pinching or stealing today's joy for tomorrow's security. It is about embracing an abundance mindset to attract, multiply, and direct financial resources towards a retirement filled with choice, not compromise. By shifting perspective from how do I save enough to how do I create and grow wealth, you will discover practical strategies that align with your values and goals and open the door to opportunities you haven't even imagined. So we've got a lot to cover off today. We've got a wee agenda. I will talk at pace because there is so much to cover off. We've got a wee chat box at the bottom. Please ask me anything because quite genuinely, I would love to help. People have submitted some really good questions prior to the session. I've got a wonderful producer in the background, Olivia. She'll be collating these and we'll go through them at the end. I'll try and keep the bulk of my content to 40 minutes and then we'll go through your questions at the end. So we'll traverse why would you want to grow wealth? Pretty obvious. Why wouldn't you? Defining how much you need for retirement. Let's get really clear on that. The principles that feed into a really good, robust plan. Let's get clear on your timeline. That feeds into what principles you should be leaning into in terms of your unique plan and different options, risks and rewards. I'm agnostic around options. It will just what will serve my clients best in relation to their goals and needs. And we'll go through a wee client example, bring this to life with a story, and I'll wrap up with key takeaways, and we'll go through all those Q&As at the end. Just a disclaimer, this information is provided for informational purposes. It is not a substitute for regulated financial advice. I would really encourage you to get personalized financial advice from somebody who is qualified. And I've got a wee sweetener at the end if you would like to seek that advice from myself or one of my amazing colleagues nationwide. We'll be offering a wee discount for an initial consult with a coach. So if you're thinking, who am I to give you financial advice? So I am the head strategic coach for Enable Me. So I work with amazing clients and I also help coach our exceptional um, crew of coaches up and down the country. I've been with Enable Me for a decade now. I can't believe it. I'm also a chartered accountant. I trained at KPMG. Feels like 1,000 years ago now. I have built and sold my own successful business. I am a regular stuff money columnist and I've worked across the world in terms of finances. And as an Enable Me coach, my clients tell me where they would like to get to, and I get them there in the quickest possible time with the least amount of effort. That is my job, and I love it. So, in terms of this webinar, again, general principles, but I do want to be really targeted in terms of content. So I've got a wee poll that I would really love you to submit, just the first answer that comes to your head. So where are you at now? How are you tracking towards retirement? I'm already retired and living well. Congratulations if that is you. I'm confident I am on track to reach my goal. Well done. I'm saving for retirement, but I'm not quite sure how much I actually need. If this is you, you are not alone. And I haven't started to think about retirement. And That is true of lots of people, and generally for lots of people, as they are in the thick of things, they've got bigger fish to fry before I get to that. Um, but my job as a financial coach is always to have a longer time horizon than my clients or line of sight. So where are we at now? So I'm saving for vast majority, I'm saving for retirement, but not sure how much I actually need. It is really important that you're able to answer that because the strategies that you execute on need to be aligned to that number. So let's try and get a little bit clearer on that together. I'm confident I'm on track to reach my goal. Awesome. Again, could you fly higher though in terms of that goal? Let's figure that out together. Lots of people haven't started or I'm not saving at all. Okay, great. Thank you. That will inform my content thereafter. So why should you grow wealth for retirement? For my clients, it comes down to two things. In all reality, ensuring they're okay for retirement means that they have more financial freedom, so kind of a choice around what happens into the future. And also it brings that element of security. They don't have to worry about money, and options are so important in terms of being able to follow a passion, having more options, and getting really clear on the problem you're trying to solve in terms of any retirement gap is important in terms of making sure that you have a really good financial plan in place. And you cannot save yourself to wealth. You know that, likely. I know that. And if you're feeling worried about retirement, you're not alone. 60%, 65% of Kiwis are worried they aren't on track to afford a comfortable retirement. And there are different versions of comfortable retirement. I'm interested in your comfortable retirement, which likely will be different to mine. 56% of Kiwis don't feel prepared for retirement, and 70% of Kiwis think they may need to work past age 70. So there is an element of clients who come to see me initially who confide that they really enjoy their job. I mean, I love my job and they would like to keep working, which I love the sentiment, but it is an entirely different proposition if you work because you want to, not because you have to. So 70% of Kiwis think that they have to work past 70. What a crying shame. Let's create more options for you and your family. 60% of Kiwis haven't thought about how much they'll need in retirement. Well, we can be a bit smug because obviously you are in this webinar tonight, so you aren't that 60%. And lots of people put a lot of credence on particular strategies, one of which is KiwiSaver. And for many people, KiwiSaver's likely just not going to be enough to sort retirement. And you can see these average balances recently came out. So average balance is 37K. And when you think the Massey University survey for a couple was you needed about 74,000 in a typical year to live a choices retirement. So as you can see, these balances generally aren't going to last that long in retirement, living a happy life. So average balance for men is 42K, average balance for woman 34K. Um, Obviously there's that gender gap that we see play out even in those KiwiSaver balances. Generally, women can be paid less for the same job. Also, that generally can be reflective of time out of the workforce to have a family, etc. Please don't catch that women are less able investors than men. Research shows the exact opposite. Women are really good investors because they keep their head. They're not swayed by headlines, Trump tariffs and the like. So just good to know it is still worth investing in it. If you are employed, for my clients as part of a really robust well-diversified plan. Generally speaking, they will match what their employer's doing. Free money, why wouldn't they? Anything over and above that, they direct into reducing a mortgage if they still have it, or growing wealth versus trapping it into KiwiSaver. For my self-employed clients, generally speaking, they'll put the minimum amount to get the government tax credit. Again, really important to make sure that you maximize those benefits. And again, that's part of that overarching, really well balanced and defined financial plan. Is it ever too late to start thinking about retirement? Really interesting. In a webinar that we delivered recently, a 46-year-old woman posed the question, I'm 46, is it too late? Spring chicken, it is never too late. It's just that the earlier you start, the easier it is. So we acknowledge that, but it is never too late. You start where your feet are, and lots of people often will wait to the stars align. So they'll think to themselves, well, when we pay down the mortgage a little bit more, when I have a little bit more security around my job, then I might think about wealth creation strategies and the like. I'll have more headspace. That time never comes, and options become less as time progresses. It's not impossible, it is harder. So again, the earlier you start, the easier it is. And I keep on talking about that really robust wealth creation strategy that brings together lots of different aspects, because you need a wealth plan, because making all of this happen requires a few different steps at different points. If you have a mortgage, and some people come to me with mortgages, some people don't, that requires you having a strategy to pay that off as fast as possible, having a surplus or excess funds to do so. And then from there, and at the same time, you need to be assessing opportunities to build wealth. Often we're trying to raise financially independent kids. That feeds or prevents plans coming to fruition. So all of these things need to be unpacked within that wealth creation strategy. So how much do you need? And for me and my clients, it comes down to, what do you need to be spending to live a happy life? And that is different for all of my clients in all reality. And there's never any judgment around that number. It is just understanding what that is and making sure that you're executing on a strategy that's growing that asset position to a point that feeds that when you're no longer working. Again, everyone has a different number. We understand yours, and we execute around a strategy around that. So generally speaking, for most people, we need to make sure that we know that happy life number, and that we time that by 25 years. So presuming, and some of my clients are more ambitious than this, which I love, but if you intend to retire at 65, I need to get you to at least 90 in terms of living that happy life. So how we unpack that number, it's that this is my happy life number in terms of annual cost, and you times it by 25 years. And as a really rough hack, generally speaking, around 60% of your pre-retirement income per year after tax. Again, understanding that number is a really important anchor in terms of the strategies you execute on to get there. So really important to unpack that. And you've also got to unpack, as part of that, where you live. I presume, and a core goal for my clients is to ensure they're mortgage free as fast as possible, because if they're not, then we have to incorporate rent as part of that happy life. And that is a big cash flow suck. And it means we have to come up with a bigger quantum. The vast majority of my clients love to travel. That's really important to them. And remember, having that abundant mindset, it's never about, well, I'm just going to live my smallest life. a lot of my clients are good savers, lots of shoppers too. But my job is never to tell you how to save money. It's saying, well, let's really figure out, well, what are the things that make you happy, like travel? Let's be intentional around that and make sure that we channel that excess cash flow as productively as possible in terms of wealth creation. And again, as I've alluded to, many of my clients would like the opportunity to retire earlier. That just means that our retirement number is bigger in terms of what we're aiming for. And of course, great to have a plan. Often, what is it? Mike Tyson says anyone can have a plan until they get punched in the face. And of course, life will punch you in the face, but doesn't mean that you shouldn't try, and also means that we embed really good buffers in terms of your strategy, which means that you can hold your line. So your hand is never forced as part of your journey to wealth creation. And you've got to enjoy the ride. Otherwise, what is the point in any of this? And when we are making sure that we have that really robust wealth creation strategy, we need to understand, well, what is your starting point? If there is a gap in terms of what you need and what you're on track to achieve, we need to put a number around that because, again, that feeds your strategy. Also, what feeds your strategy comes down to how long we have. So if you are 10 years away from retirement, or 5 or 20, it means there are different opportunities available to us. And again, earlier you start, the easier it is, the less risk you have to take on. Not impossible, but again, really encouraging people to start as soon as possible. And lots of people just concentrate on strategy. We know that financial success formula, 80% is around behavior, doing what needs to be done. 20% is around that strategy piece. It enabled me and my coaches, we marry the two to make sure we force your hand and we get a really good result for you in terms of more wealth creation and options into the future. And obviously, everyone has different opportunities in terms of where they're at, etc. And we always need to make sure that we are working with a really solid financial foundation, non-negotiable for me and my clients. And your wealth plan must have that foundation in place, ensuring you've got really good money habits, which are defined and identified. You've got really clear goals. Your cash flow is managed. That is the engine room of anything that happens thereafter. As part of a retirement plan, if you have a mortgage, we need to have a plan to address that in a really optimal manner to mitigate interest, but also make sure that we're leaning into wealth creation at the same time. Doesn't mean that the mortgage has to be paid off before you start. Actually, if you do wait, I think there's a really big opportunity cost associated with that as well. Your insurances need to be optimized. Really important that you de-risk your scenario, because for lots of people, while they are crafting a plan, while they're generating wealth, we are reliant on you working for your assets to be protected. We need insurance in place to mitigate that, but you don't pay too much. You work with a really good advisor in that regard, and you make sure that your KiwiSaver is working as hard as possible for you. You're doing what you should in terms of contributions, but you are getting the returns that you deserve. Really, really important in terms of making sure that we have that really strong foundation in place. And as I said, cash is king. That drives everything. And to grow wealth, you need to have money left over at the end of every month. And the tip here says you can use an app to track your expenses. Most of my clients will do that, not as a mechanism to judge, but actually, that is a really good way of understanding what that happy life looks like to you. Because remember, when I look at that number, that drives where I know you need to land in retirement. It drives, if you have a mortgage, how I structure it. It also drives the strategies that we will lean into in terms of wealth creation. So really important. Another tip in terms of cash flow management is not to use a credit card. Um, we know that people spend about 15% more than they would otherwise by using credit cards, just because it's a less transparent form of payment. So again, 2 tips, and great to have this webinar tonight. Great to have all this information, which I hope you're finding really interesting. But it's not the knowing of the information that gets you ahead, it's in the doing. So again, I'm really encouraging you, as you're listening to this, well, what are the key actions I should be putting in place that are going to shift the dial for me and my family? And again, encouraging you, if you're not sure, you need to seek help. You really do. And again, understanding that retirement savings gap, the pace at which you're saving is not tracking towards your goal and the time frame you need it. You need to know this in terms of plan design. Otherwise, likely you're just not going to land where you need to in terms of retirement. And remember, that just feeds into sacrifice and less choice. And for most people, they put more effort into planning a holiday than they do in planning retirement, and you are retired for a very long time. Make sure it is the best retirement that you can hope for. And sometimes these numbers frighten my clients initially. And obviously, I've been doing this for a decade, and it's never the quantum of number or gap that scares me, it's in the not knowing. So if you have a retirement savings gap of 1 million, so where you project your land versus where you need to in terms of optimal lifestyle times 25 years. So if your retirement savings gap of 1 million and you're mortgage free by 45, you'll have 20 years of compounding returns in your retirement savings. If you're mortgage free by 55, you have 10 years to save. So likely you'll need 10% of compounding returns after tax. So again, it's never too late to start. It's just the return required to bridge that gap gets higher because again, the time frame is shorter. And if you're mortgage free by 65, and again, there's never any judgment in these numbers or your starting point, knowing that on average, first time home buyers at the moment in New Zealand is 36, and it takes us 30 years on average to pay off a mortgage. So if these are your numbers, there's no judgment around that. But again, there is a problem in terms of retirement. So we need to course correct on that. So if you are mortgage free by 65, you'll likely need to work longer or have a strategy to close the gap. Non-negotiable. And you can see how critical that mortgage reduction strategy is in terms of options going forward. And lots of people will challenge me around this. And again, I've been doing this for a decade. I've seen lots of cycles. And even when interest rates were low, 4%, and we're getting down there again, people would challenge me and say, well, I think I can get a better return in terms of funds, shares, etc. I would rather lean into investing versus paying off debt. But what you don't factor in terms of paying off debt is when we're talking about investment returns, we have to take off tax and fees. Paying off a mortgage is risk-free after tax money. And again, paying off that debt is one of your biggest cash outflows. When you are mortgage free, you have more left over to invest, or you have less you need to come up with in terms of asset growth into the future. And I'm an accountant. I love graphs. So for a lot of people, their default retirement projection is pay off their debt by 65 in terms of their home. KiwiSaver in this example, last a few years until 69. So they have quite a gap in terms of wealth creation that they need to bridge. So they need to make sure that they can come up with passive income or appreciating assets that could fund that good lifestyle from 69 to 90. That is a large gap. Is it an unattainable gap? No, you've just got to understand that sooner rather than later. So again, the earlier I can get my clients mortgage free, the more options that we have. Remembering that we aren't waiting to grow wealth until you're mortgage free. We're making sure that we're creating more capacity to do both concurrently. Really, really important. And how I see that for my clients is there are four pillars. First pillar is that cash flow piece we've talked about. You got to have funds left over to channel accordingly. Secondly, get rid of debt, dead money to us, remembering there's good debt and bad debt. And thirdly, we need to grow wealth. And likely for you and me, we need to do that concurrently. We clear debt and grow our wealth at the same time to land where we need to. And I've got three children. A good many of my clients have children or nieces, nephews, etc., that they want to look out for as part of their financial plan. And often people say, well, what's the best thing we can do for our kids, our whānau? And that comes down to that fourth pillar is we create financially independent children. So my answer to the best thing you can do for your kids is to sort yourself out. That gives you more ability to help them, but more importantly, you teach them the rules of the game and they do what you do in terms of wealth creation. So again, just bringing that to life with a graph, that early mortgage repayment, if you can get mortgage free by 55, you've just got more. I mean, there's no tricks around this. You've got more capacity to save, invest, therefore your money lasts longer. So instead of running out of money at 69, you run out of money at 80. You're still running out of money, but that time is shorter in effect. So in terms of wealth creation, the gap that we need to bridge in terms of other strategy is that lifestyle between 80 and 90. That's really important. And there are lots of options to bridge a retirement gap. Um, we all have very similar options. Vast majority of people in New Zealand invest in, and I will show you this in terms of risk and return. Obviously, at the outer end, there is business, lots of risk, lots of return. Um, Business is hard. If you're in business, I tip my hat off to you. I know it's hard. There are big payoffs, but I always kind of roll my eyes when people come to see me and they're like, I think I'm going to start my own business. I just want more time and more freedom. That's why you're having a business. Likely business isn't for you. But anyway, business, there's shares, property, managed funds, and lower risk and return is around that cash piece. And lots of my clients come to me with varying degrees of cash, and it is a non-negotiable for me that my clients have a really good buffer. But I even think in terms of buffers, you can put them to good work, work, and again, protect them into the future. For example, if you have a mortgage and savings, that doesn't make sense to me. Of course, you need a buffer, but I would argue you would offset that cash against the mortgage on the proviso that you can reaccess it going forward, because you always pay more in interest on debt that you receive in savings, and then you pay tax for the privilege. And in terms of that savings gap, the bigger the gap, the more the gain that we require. And again, that means that we lean into certain strategies over others in terms of returns. And I've had lots of questions of late around the volatility we're seeing in the market. Should I change my strategy, Katie, because of the volatility? We've seen the market be on quite a ride. since Trump came to power in terms of tariffs, etc., a very rocky road. But again, we have seen the blips in the market before. It is all about understanding, well, is my time horizon and my investment strategy still hold? If you have decades to retirement, well, then you can see the ebbs and the flows of the market. If you are in high growth, again, this is not individual financial advice, but if you are in high growth and and you're just about to retire and you need those funds immediately to help you live, or you're just about to buy your first home, you've really got to question whether that is the right fund for you to be in terms of high risk, lots of volatility and uncertainty. So again, it's all about understanding your plan, your time frames, and your risk tolerance. That's what you assess. We try and rise above the static and not throw the baby out with the bathwater. Really important. We know volatility will always exist. It's making sure that you can hold your line and do what needs to be done. And you think back to COVID times when March 2020, when we were all frightened at home, never seen this pandemic before. And do you remember reading, and I hope this wasn't one of the attendees, people crystallizing their paper losses in their KiwiSavers by shifting them from growth, which had already dropped, down to conservative. Therefore, they missed that bounce back, which we know in hindsight was just around the corner. So again, really important to understand those time frames. Volatility exists, making sure that you're investing in the right things to make sure you can hold your line and you don't have to crystallize those losses. And in all reality, there's pros and cons of all those different investment types. And lots of my clients have a really well balanced approach, which has lots of different things in it. It's just where do we lean in terms of age and stage and risk and what we're trying to achieve in terms of goals. So, pros and cons of term deposits, obviously, they're very liquid, they're passive. Drawbacks are really low returns. Likely you'll be banking a loss if they're not keeping up with inflation. So again, lots of people think they're safe by having savings term deposits. But again, if they're not even keeping pace with inflation, you are banking a loss on those funds. So not so safe really in the long run if you aren't doing that. Um, Pros and cons of managed funds. For a lot of my clients, particularly as they get closer to retirement, they're more leaning into that managed fund piece because it gives them that element of diversification and liquidity. You're not locked in for a long amount of time. Very liquid. You could access them tomorrow if you so chose. Again, for lots of people, it's understanding, well, what is the right managed fund for you? And obviously understanding that fee component. And again, there are vastly different returns across those different fund types, but they are also the flip side of that is the higher returns likely have more volatility. So you'll see more ebbs and flows. So again, aggressive, average return 7.7, but that will have more ups and downs. It's more of a roller coaster versus that conservative 2.45, but more even in terms of asset mix. So again, it's understanding, well, what do you require in terms of returns to solve the problem around retirement, and how do you cut that in terms of strategy? For a lot of my clients, they will lean into property. Uh, why is that? I think for most people, it's not that property gives you exponential gains. The beauty around property is you can leverage, and that's one of the wonders of personal finance. You put in your money, the bank puts in their money, and you keep 100% of that gain. Likely, if you need to grow wealth to sort retirement, if that gap is 300,000 or more, likely you need to lean into property as part of that overarching plan. Is it the only thing likely you should do? No. But again, if you have a mortgage-free home, if you or you have lots of equity sat within that property and you're not leaning into investment property, the cost to you of not executing around investment property is that you are not getting the capital appreciation of another property through that next cycle. And that's important for my clients. But again, you've got to buy the right one and you've got to have a really good hold strategy. And for most people, property is a longer term strategy. You buy it and you hold it through a cycle. Really important. And people think that they have an infinite amount of time to execute around property. You don't. The older you are, the harder it is to borrow money. Again, stars won't align. It's just the right time for you and buying the right property. You've got to get really clear on that in terms of plan design. And again, if that gap is greater than 300,000, you're likely going to need to use leverage to bridge it because you've just got that capital appreciation of that bigger asset, which is required in terms of bridging that gap. And again, that leverage piece outperforms other asset classes by 250%, not because it's amazing, it's just because you have that appreciation of that bigger asset. And again, just kind of distilling that a little bit more, you could put 160,000 in a managed fund, growth rate of 6%, great return, versus you put that 160,000 as a deposit on an $800,000 property, that 6% on that $800,000 asset is 48K. So again, that's the beauty around property. But am I saying buy any property? Quite the reverse. You buy the right one, and that right one for you is, what do I spend up to? What is the capital gain required? And what is the yield so that I can hold it, not placing too much downward pressure on you being able to still live that happy life along the way. And again, volatility is important. We're not throwing the baby out with the bathwater. But as you can see here, red is property and it's seen as the least volatile asset class. And that's really protective when you're crafting that overall holistic wealth creation plan. And I had a client recently come to see me and she said, I hear you're pro property. I will dissuade you from, I am not pro property. I am pro doing what needs to be done to grow wealth. Lots of my clients lean into managed funds, but you also need to acknowledge that if there is a problem, you need to solve it with the most appropriate lever for you and your plan. So really important. I'm not pro any asset class in particular. It's just what will serve you. And we know that property cycle is about 10 years. That's the length of time it takes for a property to double in value. Generally speaking, Auckland has the shortest property cycle, biggest economic drivers for growth. If you go down to a more smaller town, their cycle might be much longer, but on average it's about 10 years. It does not go up in a linear fashion. You know that, I know that. Generally speaking, it's the back end of that cycle that you really see that upswing in value. And often when I chat that through with my clients initially, they're like, oh yeah, cool, cool. Can you just tell us where your 7 is? And we'll just buy then, Katie. Trick is you only know it's the bottom when it rises again and you look back and you're like, should have bought another property. So that's really important to clock. It's you buy the right one and you have the ability to keep it. If you were waiting to execute around wealth creation until you're mortgage free, and that might take you 10 years, 15 years, etc., the cost to you of doing that is you don't have that capital appreciation. That equity just sits within the one property. And again, you still might choose that that's not the right thing for you to do. But again, you understand the opportunity cost of that. And lots of different things feed into what drives property, location, interest rate cycle is a big driver. We know that interest rates are coming down, thank goodness. And that is quite stimulating, or has been historically, for property prices. But everything's a cycle, not scared of cycles. It's just understanding what that means to you in the crafting of your own strategy. And again, not all property is a good property. Not all properties go up at the same time with the same time frame. So it's understanding what is the right property for you and that hold strategy in the context of your plan. And oh, sorry about that. My slides have just decided to stop working. Where have you gone? Huh, it's never happened to me before. I will keep. We will play from the beginning. Here we are. Olivia, can you see my screen?
Yes, hang on, sorry. Yes, we can see that. Yep, so
You can
just
see it all good? Am I back to the beginning?
it is at the beginning, so you might just have to flick through to the slide you on.
Okay, I will whiz through. Just as well as I've been doing this for 10 years, right? Okay, so where are we? Leverage, property, volatility, right? And with any investment comes risk, and risks around property is you buy the wrong one, you commit to a too high top up, you work with the wrong builder, and you're not building in cash flow contingencies. And again, you never design a plan for the best day. You design a plan for if things might go wrong, and you build in buffers around that. Does that stop you beginning? It shouldn't, but it's understanding, well, how do I mitigate risk as much as possible? And I've had a question, and I will address that soon in terms of that good managed funds. Thanks, Sarah. And the secret sauce to successful property investing, often people will say, when should I invest? Is there a perfect time? I would argue if you can secure lending, likely you should. And that translates to a property that feeds into that strategy. You should. Likely, if you have sufficient cash flow so that you can sustain any top up on that property. And again, lots of people put lots of effort into the acquisition of an investment property. I'm also looking at that hold strategy because that de-risks it, the ability to hold it. So we kind of run the numbers with a very fine tooth comb in terms of holding it. And you buy the right property for you, and that's different for different people. Most of my clients buy new. Why is that? It has a master build guarantee for 10 years, naturally de-risks that you can borrow more because you need a smaller deposit, and also attracts a better tenant. So again, it's that crafting of that property piece, and you need to make sure you always have a good buffer, whether that be access to a revolving credit, etc. That means resilient, and that's a resilience, and that's a non-negotiable. And just to wrap things up with a wee example. So these are clients, Jim and Kathy, 51 and 55, came to us with a retirement gap of 550. They bought a 3-bedroom home in Papamoa in 2020. And you might think, oh, well, of course you would have bought in Papamoa in 2020. It was actually really hard for lots of my clients to purchase at that time. Obviously, we still had COVID in the background. For a lot of people at that point in time, that's what they had paid for their house, etc. It felt like a lot of money, and it is still a lot of money. But the CV today is 860,000. That's 195K of capital growth. Jim and Kathy could not have saved that in terms of appreciation. And if they hold that for another 10 years, they'll be able to close their retirement gap. And again, sometimes those gaps, when you figure them out, and I really encourage you to do that, or if you can't, you reach out to a qualified advisor. If the number is big, that never should scare you or an advisor. It just means that you have to execute on a really clinical plan. So you can see, that 550,000, that is a lot of money, but for them, it was making sure that they added on that property piece in terms of their investment strategy, and that one property for them have solved it. For some clients, it's two. For some people, it's two properties and managed funds. Again, that's understanding what is the problem we're trying to solve for, what is your retirement number, and what is the time frame that we're executing on. And is a plan just lock and leave? Absolutely not. It needs to be flexible. Life flexes. Lots of my clients over the last 5 years have been through a lot, like you, I'm sure. COVID, redundancies after redundancies after redundancies, really challenging times in terms of business. We're not afraid of hard at Enable Me. It's just, it means to us that you have to be strategic, you have to lean in, really important. And having that mindset, focusing on what you want, not what you don't want, is a really important factor for success into the future. It really is. And that flexibility, having those buffers, making sure you're purposeful with that cash flow piece, having that wealth mindset and that really strong foundation, they are the ingredients of a really robust plan that can weather storms. So, in terms of key takeaways, uh, consider the problem you're trying to solve, understanding the different investment types available to you, understanding how that feeds into returns, the time frames that you have, your risk preferences, the risks you need to take to make sure that you land where you need to. And I really, again, would encourage you to work with a trusted expert. That time piece is really important. It's never too late to start, but the longer it takes you, the harder it is, in effect. And as we wrap up tonight, remember that an abundance mindset isn't just a concept, it's a powerful tool that transforms potential into reality when applied to your unique financial situation. Well, these strategies have obviously helped thousands of clients bridge their retirement gap and create lives of choice rather than necessity. Your journey deserves personalized guidance. It really does. That addresses your specific circumstances, goals, and opportunities. And I have an offer for you tonight. If you would like to book a consultation with a coach like myself, we've got coaches, they are amazing, up and down the country, 90-minute session. You jump on the financial scales, we'll figure out together where you're at now, where do you want to be, are you on track, and what do you need to do to land where you need to longer term in terms of retirement. We get clear on that retirement number and the optimal strategies available to you to get there. We'll identify your biggest wealth building opportunities and create a really clear first step towards your ideal retirement. These sessions do fill quickly. This 149, it's usually 400. That offer is if you reach out to us tonight. If you watch a recording, you want your partner to see this, we will still give you a discount, but it's 249 versus 149. So usually 400, still a great discount, but that 149 is only for tonight. So scan the QR code on your screen now, or you visit the link to secure your spot. And please don't let today's insights become tomorrow's what ifs. Take this moment to invest in your financial future. Financial abundance, it's not about luck. It's not even about privilege. It's about making informed decisions today that compound into extraordinary outcomes tomorrow. And I really look forward to helping you discover what's truly possible for your financial future. So let's wrap up with that Q&A.
Thanks, Katie. We do have a few questions that have come through. So the first one is there a standard portfolio risk spread based on the different life stages? I know that some financial advisors can model a life cycle portfolio that progresses from low risk to high risk investment makeups.
Yeah, they can. And obviously, that's very specific to the individual and their goals. And when we assess clients at Enable Me, we tailor that risk piece and anchor it to their numbers, their specific numbers, in terms of all good and well understanding risk profiles, etc., and returns. Really important to layer that with what do you need to do to ensure that you live the lifestyle you want. And we get really specific around that number based on your actuals. So again, there are absolutely averages available, etc. They vary wildly, in my opinion, to the actuals I see with my clients. So that's really important.
Great, thank you. How do you evaluate if you are on track for having enough money in retirement, especially when factoring in inflation? I am 17 years away from being at retirement age.
Such a good time to be looking at this. I see lots of clients in your age bracket. And I suppose the question first is, are you figure out how long, if you're not mortgage free, figure out how long it will take you to be mortgage free. Then we take, well, what's that surplus? We times that by I'm always really conservative because I like to overachieve rather than underachieve. A amount of a conservative return. I understand, well, where do you need to land in terms of that happy life spend? Um, Being 17 years away from retirement, I will factor in super. If you are younger, likely I won't, because I think there's a bit of a question mark there. And that's how we figure out that calculation. So, what is that projected net asset position? Where do you need to be? That's the gap. And then we quantify when you'll run out of money and how long I have to make up that gap. And then we talk about, well, what possible strategies would bridge that gap?
Great, thank you. Property has been a favorite investment option for retirement savings for years. Do you
Yeah.
see this changing anytime soon?
Yeah, probably not, if I'm honest with you. And again, to me, it's not that property piece, it's that leverage. That is really important because you acquire a bigger asset. Leverage is very protective in a financial plan as well because it de-risks inflation as well because again as things cost more your debt effectively is worth less, so it's a really important marriage. So I don't see that changing. Someone will always need somewhere to live. We've got projected population growth. um, some people say to me, well, what if property doesn't go up in value? And you're like, so you'll tell me the cost of everything else will go up with inflation except for property? That just doesn't make sense to me in terms of dynamics. So I think it's important. Is it the be all and end all? Certainly not. It's just where do you lean, age and stage, and what are the returns that you require? That's really important in terms of your financial plan.
Thank you. Any advice on whether to get out of the US share market right now?
It's a rocky road. And again, that comes down to time frames and goals. So again, are you direct share investing? Well, there's lots of risk around that. Is that a portion within a bigger portfolio that you intend to hold longer term? Well, again, you can see out volatility. And I would really encourage you to reach out to your investment advisor if you are at all unsure, but it does come down to timeframes and goals.
Awesome. And we've got time for one more question. My wife and I have an Enable Me session scheduled for the end of the month. What can I do to best take advantage of the session?
Get really clear on your goals, what is important to you, and make sure that you have as much alignment with your partner as possible. Um, sometimes have spicy meetings. And also, as part of that conversation in terms of goals, think about what's important to you in terms of that best life. Remember, I'm here to really lean into that abundance piece. So figure out together, well, what are the things that are non-negotiables for us? Because we want to make sure that we embed that in the plan. So again, just reiterating, it's goals. Where do you want to land? And what are your non-negotiables? Get really clear on that with your partner if you have one. If you don't, it's great. It makes it easier. But those are the two things that I get really clear on prior to the session. We'll take care of the rest.
Thanks, Katie. I'll leave to you to wrap up.
Awesome. So really hope you enjoyed the session tonight. Great questions. Thank you. If you want that personalized advice, if anything resonates with you, if you want to unpack your own position, really encourage you to scan that QR code, take advantage of that discount. And I wish you all the best for the future. Take care.